Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is January 9th, 2025. And today on our call, we have the CEO, Jeff Swainson from Simply Solventless Concentrates. Simply Solventless trades on the TSX Venture Exchange under the symbol HASH or HASH, HASH, and it also trades on the OTC under SSLCF. The company currently has 108 million shares outstanding and trades at 69 cents or about a $75 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Jeff, you're a busy guy. It seems like every time we get you on here, every couple of months, you get another transaction you've just completed. We just saw that you pulled off another one. This is another interesting transaction. So we're anxious to get to know all about the deal. And get caught up on any other updates we've got. But before we dive into that, there's a number of new members here that probably haven't really heard the story before. So why not give a brief sort of summary of what Simply Solventless is all about, and then we'll get into some of the update details here.
Absolutely. Would you like me to share the deck?
Let's do that. Yeah, that always helps.
Yeah, I think it's disabled right now.
All right, Trevor, do your thing. See if he's doing his thing. Trevor, can you?
A lot of times I don't even like flipping through the deck, so we can just go.
we can start without it, and if Trevor,
no worries. Try again now, Jeff. Try now.
All right, there you go.
Okay, can you see that?
Absolutely perfect.
Okay, so obviously some of you are familiar with our story and some not, and so our ticker symbol is HASH, of course. We were founded in 2020, and we went public in December 2023. So, a lot of people think we're quite new, but we've been around for a little while. Can you see it flipping through now, just to be sure we're good? Okay. And so our mission is to provide exceptional and personalized cannabis journeys to discerning cannabis consumers. And our vision, which, a lot of people may say you never talk about profitability and vision, but we do. Our vision is to be the most profitable cannabis company in Canada through customer connection and prudent capital stewardship. And so really what we mean by that is that we approach this business from the view of fundamentals. We wanted to build a business that was fundamentally sound, with focused on profitability, focused on balance sheet, and then sustainable positive revenue growth. And so in summary, for those that are new to the story, how we've achieved that essentially is two main avenues. Number one, with our house brands and organic revenue growth. So our house brands are Astrolab, which was launched in May 2023, and Fruity Hootie, which was launched in November 2023. I'll get into more detail on what those brands are in a later slide, but those are what we started with on the CPG side. And then, of course, acquisitions. I think, we're becoming fairly well known for being a consolidator in the space, and we're quite novelly positioned in that regard. And so we've completed 4 acquisitions so far in 2024. And one pending closing in Delta 9. So in January, we acquired Lamplighter, which was just a brand. In September, we closed the CanMart acquisition, which we actually entered into a services agreement on that acquisition first. So we ran the company for 3 months before we even closed. And then we closed on the ANC Inc. acquisition in October 2024. And I'll get into details on what these businesses do later on in the presentation. And then December 30th, we announced the Delta 9 biotech acquisition, which is a cultivation asset that's currently in CCAA. And so with these, the two-pronged approach in our strategy, on the organic branded revenue growth side, this is a question that's often asked is, well, you guys are great at acquiring assets, but can you actually grow a brand and organically expand revenue. And so with Astrolab and Fruity Hootie in 2024, we actually grew the revenue in those brands by 420%. We've had 4 straight quarters of revenue growth. We have about 6 million of working capital after we've made payments to ANC regarding our acquisition and VTB payments and the Delta 9 Biotech acquisition costs, which I'll get into more detail in later. And what's, probably we're most proud of in the business is that we now have 8 quarters of normalized net income profit. Obviously, net income profitability was at the beginning of 2024 in the industry. It was really a bit of a unicorn. It just didn't exist broadly. The odd company would have a profitable quarter and then slip back into losses. And we've managed to string 8 quarters together, and so we're very proud of that, of course. And with the Delta 9 Biotech acquisition pro forma, we're looking at approximately 15 million a year of adjusted EBITDA, 13.9 million of normalized net income. And with 122.6 million shares out fully diluted, that's a 5.1 time EBITDA multiple. So, and again, we'll get into more detail on the multiple and where we sit in terms of our valuation later on. And so on a pro forma basis, in 2023, we did 7 million revenue. In Q4, we guided 47.2 million annualized, and pro forma with Delta 9 and some organic revenue growth, which is, we feel modest. We're projecting 67 million revenue approximately for 2025. And on a per share normalized net income basis, which is really what we pay most attention to, we've grown from 4 cents per share in 2023 to 9.5 guided in Q4 annualized, and then pro forma with Delta 9, approximately 11 cents per share normalized net income. So growth is nothing without profitability and without fundamentals, and whether it's on the organic side or through opportunistic acquisitions, we're maintaining profitability and running a very lean ship. And so in terms of our brands, as I mentioned before, Astrolab was our first brand. It's a fully solventless brand. So what that means is that we only use heat, water, and pressure to extract the cannabinoids out of the material. So it's a connoisseur product. It's very, very premium, but we're able to do it at with economies of scale, and we're able to provide incredible value for those products. The second brand that we launched is Fruity Hootie. So we call it live rosin amplified distillate. So distillate and flavored distillate products, whether it be vape pens, infused pre-rolls, or otherwise, dominate the market. And so we wanted to participate in a larger volume product base. And so Fruity Hootie is a twist on that. It adds full spectrum cannabinoids, such as solventless live rosin, into the flavored distillate products. And that's actually our #1 brand right now in terms of revenue. In the CanMart acquisition, we acquired Royalty. Royalty is a hydrocarbon concentrates brand. So it does dabbable live resin, diamonds and sauce, wax, infused pre-rolls, all based on hydrocarbon extraction. So hydrocarbon uses generally butane to extract the cannabinoids. It's a very efficient way of extraction, and it's also a very high-end consumer connoisseur product. Lamplighter is the first acquisition that we made, and it was just the brand. We didn't buy the corporation. It was just the intellectual property, including the website and the product listings with the provinces. And so it's ultra high potency flavored distillate. So vape cartridges that are over 90% THC, infused pre-rolls that are over 50% THC. So very, very potent and flavorful. Zest is hydrocarbon vapes, so liquid diamond vapes. And Status, one of the brands that we're very excited about, came with the ANC acquisition. It's their first brand, and it's focused on infused pre-rolls and blunts. But as you can see here, I mean, this is a glass-tipped, keef-coated infused blunt. The innovation that ANC is bringing to our company and the bench strength that they've added in terms of our our executive team and our ability to innovate is just absolutely exceptional. And then 34th Street Seed Co. came with ANC as well. And so it sells seeds. It's the biggest seed distributor in Canada on the legal side. So we essentially, at the end of the day, we have a scope of products for all types of consumers. We're not trying to tell people what they should enjoy or what experiences they want. We're trying to meet them where they are. A lot of consumers have already figured it out for themselves. And so we have something to meet the needs of all consumers and to give them a good experience. And how those brands translate into results is really through product listings. You of course need to drive velocity through retail, but product listings are a proxy for revenue. There's a strong correlation, and as you can see here in the bottom left, Astrolab was our first brand, and it was our first product listings. So we launched that in May. We started with 7 listings, I believe. And then over time, you can see up until the end of Q1, we're projecting, close to 50 listings with Astrolab. And so that's why we had that 420% revenue growth, or one of the reasons why. Our second brand, Fruity Hootie, you can see the same thing. Lamplighter, when we took it over, we had a dip in revenue. And that's kind of a consistent trend, because the reason these entities are divesting of assets is because they no longer wanted to participate in B2C sales in Canada. And so we're able to pick them up and then just ramp them back up again. And so that's what's happened with Lamplighter. We've increased the listings consistently through the year. Royalty, the same thing. We're launching a lot more royalty products in Q1. Zest, and then Status is just starting. They just launched it in basically December or October, I guess, and it's gaining a lot of traction. It's doing very well. And then of course Delta 9. And so over the from May 2023 up until today, we've increased our listings from nothing all the way to almost 250. And then of course the Delta 9 biotech acquisition. We've been working very hard on it. It was a very robust process. As I mentioned, it was in CCAA, and there were a lot of bidders. There were a lot of NDAs executed, a lot of interest, and fortunately, we were able to win the bid. And so, essentially, we're a Cannabis 2.0 company. We were founded on Solventless, which is the most niche Cannabis 2.0 company that you can be. The market just isn't there to have a sustainable growth story in the industry. And so we've expanded throughout the Cannabis 2.0 space to where we're in all product categories. We're now in beverages and edibles. I'll just show you quickly. That's our beverage there in the top left. One of them, we have a cream soda and a lime. So and that's a solventless beverage. We have solventless edibles. Obviously, we have traditional hash. We have vapes. We have infused pre-rolls. So we participate in all of the Cannabis 2.0 and 3.0 products, and we don't participate in dried flower as of today. And dried flower is still 40% of the market in Canada. So for us, it was compelling to acquire a cultivation asset so we could participate in that largest product category, but also because we're really seeing a balancing of the supply-demand dynamic in Canada. ANC, they're an infused pre-roll manufacturer, predominantly co-manufacturing, and they use about 600 kilograms of flower per month, just ANC. We use a lot of dried flower in our infused pre-rolls for all of our brands, our Astrolab, Fruity Hootie, Lamplighter, Royalty. They all use dried flower. We use a lot of trim in our extraction processes to make hash. And we've noticed that prices are going up. It's harder to get material. And we need a strong, reliable, repeatable supply of material. And so for those reasons, we did want to vertically integrate upstream into cultivation, and we were able to win the bid on this asset for terms that we believe are very favorable. Overall, it's a purchase price of $3 million. It comes with at least $2 million inventory minimum. plus work in process inventory, which we expect to be over $1 million. So we believe we're getting over $3 million worth of saleable or soon to be saleable inventory, which brings the net purchase price to nil. And we're adding about 12 million annualized gross revenue, and post integration approximately 2.5 million adjusted EBITDA. And so on a gross basis, not accounting for working capital received, it's a 1.2 time EBITDA, and net of working capital, of course, it's a zero time EBITDA multiple on this acquisition. So very attractive metrics. And I've gone through some of the list here. I'm not going to repeat it. Of course, the tax pools are one that I haven't discussed. We're getting the use of approximately 60 million of tax pools as far as we can tell right now, and at modest tax rates, that's upwards of 12 million of value. And overall, we're increasing our EBITDA on a pro forma basis post integration by about 24%. So if you're looking at this on a net basis, we're basically increasing our EBITDA by 24% for basically nothing, which we're very, very happy with that. And in terms of synergies overall, so we do vapes, we do infused pre-rolls. Delta 9 currently sells vapes and infused pre-rolls. They have all their vapes third-party co-manufactured. So we're going to bring that in-house to our massive hash factory facility near Calgary. We're going to bring all the infused pre-rolling into ANC, which is, some of the most efficient pre-roll operations in Canada. And so there's a lot of synergies to save capital, to lean out the operation within Delta 9 in Winnipeg, and to really capture the synergies, which is critical in order to make our consolidation strategy effective. And so overall, we always have to look back and see, are we actually creating value here with these acquisitions? It's been a lot of acquisitions, and I'll get into integration, which is something that needs to be, discussed, because it is a concern. I mean, can we even integrate this quickly? It's a question that comes up, and it's very valid. But in terms of the acquisitions themselves and the metrics, at the end of the day, with the 4 acquisitions, including Delta 9, which is yet to close, we've paid 6.15 million of cash, which some of those payments are still to be made, 5.25 million of equity, a 2.1 million of vendor take-back mortgage, for total consideration at max earnout, because ANC has an earnout of 3.5 million. So at max earnout, it's a total of 13.5 million that we will have paid. And for that 13.5 million, we've added approximately 45 million of annual revenue, and 10 million of annual EBITDA, which is, acquisition metrics of 0.3 times revenue or 1.35 times adjusted EBITDA. So very attractive metrics. We're currently trading at 5.1. So the way that this is accretive is clearly just on a per share basis, it's accretive, but we're taking assets that are underappreciated, not run well, and we're able to disseminate our operating capability to those assets and ultimately turn them around and turn that 1.35 times EBITDA into a 5. And that 5, we do believe that we're fundamentally undervalued. And so that's really the strategy here with the acquisitions. And there's been some acquisitions that are extremely modest consideration, like CanMark, for example, which was $2 million total consideration. And then there's been assets that were significantly more consideration, such as ANC. And so, we're not only looking at distressed assets, we're looking at distressed assets, quality assets, and everything in between. As long as there's good strategic fit and they provide good synergies, and that they're going to contribute to profitable per share revenue growth. And here's where we are today. This is really the slide that we track and we try to understand where we sit in the market and where our strengths are as a company. And as you can see, the top chart is an EV over adjusted EBITDA. So on average, of these competitors, the average multiple is 14 times EBITDA, and we're at 5.1. So you would think based on that we were not profitable, or we had significant debt levels, or there was other significant risk with our business. But it turns out from the bottom chart, you can see on average the net income is minus 4%, and we're at 21% net income percentage, normalized net income. And so we believe that there's a mismatch in our fundamental valuation between what we're doing, executing on a day-to-day basis to generate profitability, and our multiple. And then, of course, team. Jeff Holmgren, we just added as CFO. He's a very strong CA, 15 years experience in public and private companies. Jeff Lawrence, Chief Commercial Officer, incredible sales professional. Actually has an engineering degree, but he's just an incredible people person and relationship builder. Murray Brown, just a diligent, structured, organized, incredible 40-year engineer. And he's really in charge of a lot of our integrations. He's done an incredible job with those assets. And I'll get into the integration after I talk, speak about our team a bit first. And then Terrence Rudder. So with the ANC acquisition, as I mentioned before, we added incredible bench strength. I mean, we added 4 top shelf executives. So Clayton Bordeniak is ANC's CEO. Terrence Rudder, who's ANC's president. We brought Terrence onto the SSC side as well as our VP marketing and product development. And what he's doing with our products is just absolutely incredible. The innovation in the product launches for Q1 is through the roof. The infused pre-rolls that we're developing are, in my opinion, industry leading. And from an organic revenue growth perspective, I believe we have a chance to do something very, very special on the infused pre-roll side, in large part because of the ANC team and Terrence in particular. And then James Clark is their COO. He's not in a role with SSC, but he's COO of ANC, and he's touching our entire business, contributing across the board, doing an incredible job. And then Thomas Facciolo, he's their VP of product development with ANC, and the same thing, just an R&D master and knows the consumer, knows the products inside out. And then our board, Bill McDonald. So Bill is the co-founder. Bill and I founded the company in 2020. He was an oil and gas landman for years and years, and really he's been on about 25 public company boards. Just an incredible deal maker, very, very bright individual, incredibly loyal and supportive of the company. Steve Bjornson, he was, if not a co-founder, a very early stage at Vermilion Energy. And then he was at Valura Energy as CFO. Incredibly talented corporate governance. He's a chartered accountant again, and great experience. He's on the Cemetrix board as well. Olin Vanderleden, he's a 5-year cannabis professional. Before that, 15-20 years of executive level BD experience. He was with Zenabis Cannabis and then Green Tone after that as their CCO. And he's just an incredibly talented individual and deal maker. And then, of course, me. And so, we have a really good team. We're a lean team, but we're all very much invested. We own about 20% as an insider group of the company, and we participated in every single round of financing, and we believe that's important. And so we're very committed to the company, and we work very hard to ensure that our shareholders achieve value creation. And so that's the presentation. And, I'll address one of the questions even before we get into questions, and that is integration. Obviously, when you do 3 acquisitions and you have a 4th, set to close, the question is, can you integrate these assets? And the answer is yes. We've become very proficient at integration. It's become somewhat of a core competency of ours, and each acquisition is different and has its own challenges. So Lamplighter was just the acquisition of a brand. So we didn't need to integrate a corporation. We didn't need to integrate a team. We just had to do all the license or the appropriate licensing and listing transfers to get them under our licenses. So that was a fairly seamless integration and was integrated within a month after acquiring it. Canmart, that was a different story. That was an acquisition of a corporation and a license holder in Etobicoke, Ontario. And so, of course, the integration was much more robust than that, but we structured that deal to where it was in June, we started a services agreement where we had full operational control prior to closing. And then 3 months later, we closed. So by the time we closed, we had already done all of the heavy lifting on the integration. We had rationalized the asset and leaned it out and achieved profitability before we closed. So, that one was a much more challenging integration, but we got a head start on it because of deal structure. And then ANC is yet again a different type of an asset. It's a going concern, highly profitable cannabis LP in its own right. And so we didn't need to do a lot of integration. We have to, of course, integrate systems and make sure that our kind of shared corporate services are aligned, but ultimately it's just running itself. And so, while the integration isn't complete, it's well underway, and it's much of a easier lift than, for example, the Canmart integration. And so with these different types of integrations and the number of integrations that we've done, as I mentioned, we've really developed a core competency at integration, which is, of course, with our positioning as a consolidator in the space, and as a party where LPs trust to transact with. It bodes us very well to have that as a core competency. And so with that, I'll pass it back to Paul.
Excellent. Thank you so much, Jeff. I want to remind everybody that's listening, if you've got questions, obviously, to ask Jeff, please use the chat function and we'll ask those questions. We've got some sort of lined up questions from some of the members that couldn't join us today. So I'm just going to start off with these, and then we'll jump on some of the questions that come in via chat. Jeff, in some of your past projections, Lamplighter, you were projecting you guys would do roughly 6.8 million in revenue for 2024. Maybe, can you give us any color around whether, you're hitting those numbers or how that's going so far?
Yeah, and so when we acquired that asset, it had done 6 million the year before. And so I believe we closed the deal closer to March, and I believe that it's done about 4 million since we acquired it. So on an annualized run rate basis, we're on par. We lost a few more listings than we thought, particularly in BC, which hurt us out of the gate, but it's gaining traction now. And Lamplighter is one of the brands that is really set to benefit from the product development of Terrence Rutter and our product development team and ANC in general. We're launching some absolutely incredible infused pre-rolls under the Lamplighter brand, called Lamplighter 50s and Lamplighter 40s. They're diamond coated with see-through blue papers, just incredible products. And so while the revenue is on a monthly basis now is more analogous to when we acquired it, we do believe there's strong upside with Lamplighter, and it has a pretty loyal customer following.
Perfect. Now you mentioned pre-rolls. The other question that came in is what's the addressable market in the pre-roll sector in Canada? What can you tell us there?
So infused pre-rolls are the second largest category next to dried flower. It's about 26-27%, depending on the data that you're looking at. So infused pre-rolls, prior to us integrating upstream into cultivation, was the largest product category that we could participate in. And for that reason, we wanted to have proficiency and core competency in pre-rolling, and particularly in infused pre-rolls. Not everyone is able to effectively or efficiently manufacture infused pre-rolls, and ANC has been doing it for so long. They, as far to my knowledge, they manufactured the first infused pre-roll in Canada that was sold commercially. And so it was imperative for us to be a leader in the largest at that time category that we participated in. And of course, we've achieved that with ANC.
Now, correct me if I'm wrong. So ANC is really almost a B2B pre-roll manufacturer. Is that correct? But it sounds like they're launching into B2C. Can you give us an indication just on the B2B side? Is there any contractual number that's sort of in place for 2025?
Yeah, so they've historically been purely B2B and tolling. And so they do those services for a multitude of large licensed producers. And in Q4, I know that they had too many orders that they could even handle. And so they even had to add a few staff and things like that. And so, if anything, they're busier than they can handle. They're very expandable. Their capacity can be increased very quickly with basically adding more labor. And so they're doing that. And then Status is the first B2C brand that they've sold the 34th Street Seed Co brand from day one. So that is technically a CPG brand, but it wasn't the focus of their business by any means. And Status is their first foray into the large consumer categories, I'll call it. And it's getting very, very good traction.
Is it fully launched, or is there more markets to launch into?
So it's in Alberta and Ontario, only a few listings in each. It's getting about 9 new listings in Alberta in Q1, I believe. And it's just going to do submissions into BC, Saskatchewan, Manitoba, Maritimes, and the other markets.
I mean, it seems that the few discussions I've had with you since the ANC deal, it sounds like you're pretty excited about this one product. It's every time you seem to light up when you start talking about this product.
Well, I mean, honestly, it's the product and the people. Like really, what that deal has brought to us in terms of our capability organization wide is far beyond our expectations. We knew it was a well-run company, but what they're doing for our team and Simply Solventless broadly is just exceptional, and that results, of course, in exceptional products. And the products that are being developed are just, I mean, if I go to this slide, these Fruity Hootie pre-rolls here are Keef coated branded tips. So we didn't, before ANC, of course, we knew we should be doing branded tips and everything. We didn't even have branded tips, right? We just didn't quite have that bench strength and the people in the right seats to get those things over the line. We were moving too quickly. And now, ANC is proficient at it. And part of the reason is because they've been doing that for other LPs for so many years. And so, they're bringing things like the branded tips, the Keef coating. Some of our brands are launching with diamond coating, as I mentioned. They're doing things like colored Keef, which is totally novel in the market. They're doing glass tips like the Status blunt here. So it's a cigarette style blunt with Keef coating and a glass tip. I mean, these are just things that aren't being done in the market. And with the volume capacity that ANC has and these types of products, and now the economies of scale that we're generating day by day and acquisition by acquisition, I'm just very excited by the opportunity for organic revenue growth because now, of course, Astrolab and Fruity Hootie were our first brands and they're the organic brands. But now we have to grow Royalty organically and we have to grow Lamplighter organically. So their ability to contribute with our existing team, like a guy like Braden McIntyre, Robbie Fisher, I mean, guys they live cannabis. It's their whole life. It's their culture. Supplementing our team with the ANC team really positions us to drive these brands and to drive the revenue growth of these brands organically. So even without further acquisition, I'm very excited about 2025.
Yeah. Now, you mentioned that ANC sells to some of the largest LPs. Is there any companies that you can mention? Like, who do they sell to that we might recognize?
Yeah, I can't. I'm not. They all have
Okay.
NDAs, and in the
Yeah.
services agreements, it's bound by confidentiality. But definitely some of the larger LPs, and even a couple more since the acquisition are being targeted. Also, some brands that are in other jurisdictions, I'll say, are interested in ANC as their co-manufacturing partner in Canada, and so very exciting stuff for them.
So clearly, it sounds there's a lot of potential with ANC still to grow that business.
Huge potential.
Yeah. Okay. Fantastic. Fantastic. Um, okay. Some of these other questions.
Sorry, Paul, sorry to
Yep.
cut
Go
you
for
off,
it.
but one important note there is that
Yeah.
ANC alone uses 500 or 600 kilograms of flour a month,
Mm.
right? So it's just such an important piece to our entire plan here of, vertically integrating to the point of retail where, we have no plans to go into retail downstream, but, it's a key hub for our consolidation mandate, having an asset like ANC there.
Yeah, I would almost say that one of the weaknesses I saw prior to this acquisition was just that you're at the mercy of the flour market and the pricing that we knew inevitably was going to get tighter. And as you mentioned early on, that we're starting to see that tightness starting to show up. Maybe give us a better sense, or at least reemphasize what you said. Like the flour that's grown, or the material that's grown out of Delta 9, how much is it? How much are you guys going to consume system-wide, just yourselves?
Yeah, and so we could consume almost all of it, but we probably won't. So we'll still procure some flour from third parties. Some of it we'll use internally. It depends on the grade of the flour and
Mm,
the intended market. Um, so one of the things with the Delta 9 asset is, well, there's two main things. So number one, it's GACP certified. That means
mhm,
that we can export this flour internationally. Number two, it can be with about a $4 million capital investment, which we're not planning right now. We can double production to about 15 to 18,000 kilograms per year. And so over time, we have an ability to address more of our supply chain needs through the asset or to address markets through
mhm,
dried flour sales.
mhm,
The flour that it cultivates is high quality flour. And right now, the price that's being received is on average only about $1.30 per gram. And we see significant opportunity with the tightening supply chain in Canada, and of course internationally with growing markets, to increase the selling price per gram.
mhm. Fantastic. Okay, a couple other questions here. Okay, so in the Delta 9 acquisition, you talked about inventory. The question here is, what's the current condition of that Delta 9 inventory, and are the plants currently being taken care of?
Yeah, so it's been operating status quo through the CCAA, other than they focused more on B2B as opposed to their branded sales. And so all of the inventory is in saleable condition. It's all fairly recent inventory. One of the things that's important to note is that the glut of really bad inventory in the system that was cultivated in 2018, 2019, back when funded capacity was the craze, and entities were rewarded for building ever and ever larger hybrid greenhouses. That the glut of inventory is largely depleted. And so the concern of inventory obsolescence of the dried flour is certainly diminished. And this is all fairly recent saleable inventory. And then the work in process, of course, there's about 270 grow pods in this facility, which are shipping containers, and about 200 of them are flowering. So some of them would be week one, some of them would be just about to be harvested. So it's about $1 million worth of work in process inventory too, which is not obsolescent whatsoever. It's as fresh as you could have it.
Mhm. Gotcha. Okay, more questions on Delta 9 here. It says, how much of Delta 9 sales were generated by Delta cannabis stores, and will those stores reopen?
Yeah, and so the Delta 9 retail stores are the plan is that they're being acquired by large retail chain that was the plan sponsor. So and that company is called Fika. They're the largest retail network in Canada. And so they're acquiring the Delta 9 stores. And part of this deal is that Simply Solventless is going to be their preferred white label and private label partner, and that they're going to continue to operate the Delta 9 stores, still branded as Delta 9 stores. And so that won't change whatsoever. If anything, that's going to benefit us because through this process, we've been able to develop a very, very strong relationship with Fika. And, we're excited to work with them going forward.
I think it's important that we sort of re-talk about what you just mentioned here. So Fika is the largest retailer across the country after this acquisition that they've done of the Delta 9 assets. And right now, you don't sell anything through the Fika system. Is that correct?
That's correct.
Yeah. So now you're going to be the preferred white label provider to a retail system that you haven't to date sold anything through.
Yeah, and so white label would be products that they want to continue to sell,
Yeah.
under their own brands, for example. And so there's none contemplated at this point. But throughout the process, I guess what I can say is that we've been able to develop a good relationship with them, and none of our brands are in their stores countrywide yet whatsoever. And so, of course, we want to leverage this transaction and the relationship that we've developed with them to start to be one of their customers in their stores across the country.
Mm-hmm. Now, it's my understanding that you were not the high bidder on this process. So there were other bidders involved in this, and you were not the high bidder. So that leads me to believe that they want to see this transaction because some of the other benefits they're going to get from this transaction.
Yeah, and so I am aware of multiple other bids on the asset, and I know that we were certainly not the highest bid. We were able to secure the deal. I think because of, in part because the credibility that we've developed, that we can transact, that we can close deals. I know that some bidders didn't need, they basically a lot of the bidders were ready to pull the trigger even faster than we would be, and we still want it. And I think it's a multitude of reasons. It's the credibility that we've developed. It's the fact that we may be seen as an up and coming licensed producer that has results and has been able to maintain results, and that we could be a good group to work with going forward. So yeah, we're very fortunate and grateful that we were able to get the deal, and we think that it's going to really pay dividends.
Mm-hmm. Awesome. Okay, so we'll continue with these questions here. Is Simply purchasing Delta's pre-roll equipment?
So it comes with the equipment. So part of the transaction is that there's a sale leaseback being done on the facility itself. So the real property is being acquired by a third party, and we're leasing it back long term from them. But everything within the walls of the facility, it comes with the deal. So all the equipment, we believe there's over $1 million worth of equipment in there, at least. I mean, it's got the grow pods, all the lights, all the systems, all the irrigation systems. It's got some pre-rolling equipment, which we're gonna probably move to a different location. It's even got some hash making equipment. So all that equipment is ours once we close the acquisition.
Fantastic. And you may have answered this question already, but will Simply acquire the tax loss carryover, and will SSC be able to use most of it?
Yes, and so part of the deal is of course the tax losses would stay within the entity, because we're acquiring the shares of the corporation, and so the tax losses will remain within that corporation, and being profitable. I believe we're one of the few cannabis companies in Canada that could benefit from use of those tax pools.
Yeah, perfect. Okay, so vertically integrating upstream into cultivation is a core SSC strategic mandate. Has the mandate been reached? Do you think this is sort of, is there anything else you can do outside of what you've done so far to sort of complete the platform right now?
And so as I mentioned before, the asset, it's currently at that 9,000 kilo level approximately. we can double that with some fairly modest capital. And so we have some running room on expansion within the Delta 9 facility. But there are other opportunities out there, such as outdoor flower, which we use for our extraction. We don't have any definitive plans to make an acquisition in that regard, but there is running room left in vertical integration and other acquisition opportunities as well, whether they be processors or cultivators.
Gotcha. Okay, this is a question I'm sure everybody's about to ask, but is simply generating enough cash flow from operations to pay the bills and the promissory notes, or is another round of financing required?
Yeah, and that one's tough. I can't speak details about that. I mean, we're always, open to financing in a non-dilutive basis, and we are generating cash flow. There's a difference between what the model says and what we're achieving, and guaranteeing payments and things like that. And so it's something that we're looking at right now. Numerous forms of capitalizing the business at all times. It's not just related to this acquisition or payments from past acquisitions, but just in general.
Gotcha. Okay, what is the current number of shares outstanding? I think you had said 122 is on a fully diluted basis, but I think currently it's a little bit less than that in terms of current outstanding. Do you know the number?
So it's 107 basic, I believe, and then just over 7.3 million in warrants. I'll just go to the cap tables actually out of this deck right now by accident, but it's 107 plus about 7.3 million warrants, which is comprised of 4.6 million non-forceable 20-cent warrants and 3 million 75-cent warrants from the ANC acquisition. And then there's about 7.3 million stock options outstanding with an average exercise price of around 30 cents.
Gotcha. Perfect. Okay, and I think we're getting close to the end here. Have you looked at the recent headset data? Would you care to comment? How reliable is the data?
Yeah, and so headset data is taken from the till of retail stores, and not all of them. So they take it from a statistically relevant number of stores and then extrapolate it across the country, essentially. So I would say that it's relatively reliable, but you just need to know how to use it and where to look to get the right answers, essentially.
Gotcha. Okay, just I guess a general question, which I think we've somewhat answered, but are the sales of the brands purchased by SSC progressing according to plan?
Yeah, and so with Astrolab and Fruity Hootie, they're trending beautifully. We're seeing strong growth, or I'll say basically consistent growth. It's just a nice upward trend. As I mentioned, it's grown about 420% in 2024 for those two brands. Lamplighter, it definitely slowed down once we acquired it. We had to do all the product transfers of the listings, etc. And now it's trending back up in the right direction. Same thing with Royalty. In that with Royalty, we weren't really sure definitively where the revenue was going to start. And so it started a little lower than we thought, and now we're back up to over that $1 million a month level, and trending upward. We're doing some new product launches with Royalty, refreshing some of the products, doing a bit of a brand refresh with it, and so it's going well. Zest is the same thing, and then Status is a brand that we're very excited about. Of course it's new, but we anticipate it doing really big things. So overall, the brands are performing well. I think that the organizational capability that we've developed and that we've added with ANC is going to go a long way in perpetuating that brand growth and contribute to the organic growth of all of our brands.
Jeff, I mean, number of acquisitions now and time with these acquisitions. What would you say is the biggest surprise you've dealt with here, good or bad, in these acquisitions?
Biggest surprise? That's a tough question. I guess just how each acquisition is different. you never know exactly what you're going to get. You can do due diligence, and we do great due diligence. Murray Brown, our COO, is just I mean, with each acquisition, he's been there, and he's been into integration before we even sign a binding deal whatsoever. And so, but you get in there, and there's challenges. You need to overcome challenges, and you need to be adaptable. And I think that's just part of our ethos. I mean, going back to 2020, very tough times for numerous years in the industry without any capital being available. Obviously, we were a private entity. For a time, we were working under another LP, and we had no real control. 2022 was very, very challenging with just paying the bills just day to day. And so throughout that process, we've learned to be scrappy, and we've learned to be adaptable, and we've learned to overcome challenges. And so, in terms of the biggest surprises, seeing the different challenges as they come with the acquisitions, but then seeing the team just do an incredible job of handling those challenges. I would say that overall, just our team's ability to get it done and to do a great job on integration and to achieve synergies has been very eye-opening to me, and I'm humbled to be a part of this team.
Fantastic. Okay, so now we get some questions from the live audience here. Jesus says, given our levels of inventories and the acquired inventories, do they expire?
And so there's different expiry dates for different inventory. So dried flour, it absolutely expires. It's, you don't want old dried flour, but all of our dried flour is recent. It's not an issue whatsoever. Things like concentrates, they have a much longer shelf life because most of it's frozen or at minimum refrigerated. So the shelf life of things like solventless and hydrocarbon concentrates is very, very long. We don't believe we have any inventory obsolescence issues. Of course, we have also, seen our inventory balance expand. And that's a function of doing these acquisitions. So number one, every acquisition we do comes with inventory. Number two, we need to be prepared when you're buying a brand, you're buying a company like Royalty, and it has, or a company like Canmar, and it has Royalty and Zest, and the sales have plummeted because they don't have inventory to fuel the revenue anymore. We need to make sure we have the inventory to fuel that revenue. So, we've seen our inventory balance expand a bit, but the metric that we really pay attention to there is inventory turnover. And a function of our revenue growth, it's our inventory turnover is getting into a much better place. I believe it was 0.4 times in Q2, if I'm not mistaken, and maybe 0.8 times in Q3. And we'll continue to monitor that. But first and foremost, we need to make sure that we can service our revenue growth. Of course, in the absence of concern on obsolescence, which we don't have.
Fantastic. Yeah, I mean, that's been one of the big issues for a lot of companies right now, is the ability to actually finance inventory and be able to survive. So it's good to see. Okay, so Mark asked a question around culture. How about integration of the cultures of the different organizations? How's that been?
Yeah, and it's been good. I mean, if anything, we've taken positive things from each integration. I mean, with Lamplighter, even though it wasn't a company, we ultimately hired Jeff Lawrence, and he's now our CCO. We hired him as VP Sales, but in terms of the contribution he's brought to our culture has just been absolutely incredible. Canmart, unfortunately, we didn't retain a lot of the management of Canmart, which were all outstanding and exceptional people, but it's just part of the synergies of that acquisition were a bit different. They have incredible staff in Etobicoke. I mean, just great people. A lot of their systems and processes have helped to improve ours. So they've been a big culture add as well, and a process and operational add. And then ANC, and I mean, their culture is incredible. Terrence coming into the Simply team, and their team operating within ANC has just been huge for us. They're contributing to SSC both operationally and culture wise, and they do a great job of it. And so we've learned a lot from ANC, and that's what we need to do, is just continue to learn and improve. And and just do the right thing.
Yeah. It sounds like you're taking sort of contribution from every acquisition you're making and applying it to the benefit of the whole platform.
Absolutely.
Okay, so Greg asks, I'm assuming, okay, so in 2025 PF, I'm assuming that means pro forma, revenue grows by 42%, but net NNI only grows by 15%. Can you explain the drop in margins?
So it's not a drop in margin. If you multiply that revenue times the margin, by the time it gets to net income, it's not going to equal the same 42% growth rate, right? By the time it gets through excise, cost of goods sold, and down through the fixed cost structure, it's going to deplete down. The percentage gain will be smaller on the net income side.
Yeah, is that because some of these assets you're taking on have a higher excise tax, or what would be the cause for that sort of
It's
extra
mostly
costs?
it's just a function of the P&L in general. It's if you have 10 cents revenue, like it doesn't reflect a reduction in margins at all. Like it's just a arithmetic. Literally. Like, because
Yeah.
you're taking margin off that revenue growth, or you're taking excise, COGS, and everything off that revenue, and by the time it gets to bottom line, it's just not as big of a percentage increase.
Mm-hmm. Mm-hmm. I got you. Fair enough. I mean, we probably bring up the whole excise tax stuff, but I think we'll see that for another date here. Okay, so Capital says, can you give some of your thoughts on using debt versus equity or other methods, seller notes, et cetera, for some of these acquisitions?
I'm sorry, so I just want to address one thing on the last question too, is
Yeah.
not all of that increase is attributed to the acquisition or organic, right? So it's a mix of it's a different revenue mix as well. So, like our highest margin is tolling, and our margins on the CPG products are generally around 30 to 40%. And that's consistent with our acquisitions. All of our acquisitions, the margins have been consistently around that 30 to 40% level. And sorry, your other question was now on financing.
Yeah, give us your thoughts on using debt versus equity. I know up until very recently, apart from the sort of the vendor takebacks that you've done, you've used equity to make these acquisitions, and I understand why you've done that. Most of the companies that were heavily indebted were not being very successful in the business, so you shied away from debt. But certainly your balance sheet's significantly stronger. Your EBITDA production is significantly stronger. What's your view on using debt for some of these acquisitions?
Yeah, and so really, I mean, obviously the dilution that comes with equity offerings, on a per share basis definitely hurts profitability. There's no question, but so does interest expense. And so there's a balance between those. But in this industry, having secured debt of any scale can be very detrimental. There's a lot of companies in the industry that will lend just for the purpose of trying to eventually capitalize on a default, and it's very sophisticated people, and for us, we've just, for those reasons, been relatively allergic to debt. If we're so focused on profitability, it makes it hard to assume interest expense. So we evaluate financing for its own merit, whether it be equity or whether it be debentures or convertible debentures or other debt. And for us, it's a balance between do we feel safe with this debt? How does it look on the P&L on a per share basis? What does it do to net income per share? And then we make the decision. But of course, we do want to limit dilution going forward. That's definitely important to us. We believe that we are fundamentally undervalued, trading at a 5.1. So equity offerings at this level wouldn't be attractive to us. So at this stage, given kind of the dynamic of the situation, the opportunity we have to consolidate, and the payments that we have, non-dilutive forms of financing are certainly attractive.
Mhm. Yeah, and I know that this question comes up and we get this asked of us all the time, but you're making acquisitions right now at roughly 1.35 times EBITDA. And even though I personally think your stock is grossly undervalued at 5.1 times, trading at 5.1 times EBITDA, the math still works. If you're issuing shares here and making those kind of acquisitions, the math really still works here. I mean, it's outstanding to be able to get that kind of sort of torque out of these acquisitions.
Oh yeah,
yeah.
yeah, and that's a great point, Paul. Like, and we speak to that quite often. Is it's just so blatantly accretive, right?
Mhm.
If you're adding 25% in Delta 9 deal, just as a hypothetical example, if you're adding 25% EBITDA and it's only costing you 10% in shares, if you were to do an equity offering, like it's just blatantly accretive,
Mhm.
right? These deals, and or whether you look at the multiple, it's the same level of accretion. It's 1.35 to a 5 times. It's being able to proceed without large secured debt is attractive when it's still accretive, but as you build scale and you build critical mass and you generate more cash flow, other forms of financing do become more attractive as well.
Yeah, no, agreed. Okay, so Paulo asks, would you consider changing the name of the company? It's a mouthful.
Yeah, and we're not solventless anymore.
That's right. Yeah.
It's our ethos, and we love solventless, and being solventless first has allowed us to to do a lot of the other products very well, because solventless is very, very challenging. But we're not a pure play solventless company anymore, and so we absolutely have talked about changing the name. We're not going to do it this year. Our AGM is coming up in February, and we're going to continue with Simply Solventless for now. We may change it in the future. We don't have definitive plans to. The downside, of course, is I do think Simply Solventless is becoming fairly well known, and the name itself maybe even has some brand equity, and so something that we think about, and that we'll keep tabs on moving forward, and make a decision. Maybe we'll have a poll someday on what we should do.
Exactly. Yeah, no big rush. Okay, big question here from Joseph. Says, given the ops pertaining to growing dried cannabis, would you be open to divesting the most recent acquisition if it ends up being a distraction or never is accretive after a year or so? I mean, any of the assets, I mean, do you ever consider, reselling them at some point for whatever reason?
We haven't seriously considered it. We've had people, we've had companies approach us to acquire an asset, or whatever the case may be. I think that for us, with this mix of assets and the company we're building, I believe there's just so much upside with what we've built, and I think that each one of these assets brings something unique to the table, and adds to the synergies and the strategic fit. And I don't think that we're the same company without any one of these acquisitions being a part of our organization. And so at this point, no, we wouldn't be interested in divesting these assets. We think we can create value for our shareholders with them. But in the future, you never know what may happen. We're always evaluating, and we're deal makers, and we want to do what's best and going to create the most value for our shareholders. And so right now, we believe that's building this company with the assets that we have.
Mm-hmm. Now, I've got to stress, everything I've learned about the industry over the last couple of years, I think the platform that you guys have developed right now, and especially with this last piece of the grow piece, I think you've really done an outstanding job of sort of filling in the holes that you had. So I'd have a hard time believing that you'd be looking to turn around and sell something right now when you've just done what I think is a great job putting the puzzle together, so to speak. Okay, so I mean, on the flip side, would you be open to the sale of the company? For instance, the U.S. private equity seems aggressive in Canadian acquisitions recently, although uncertain about the cannabis industry. Well, you mentioned some people are knocking on the door right now, but what's your view around sort of further consolidation? We saw Organogram, buy Motif. So there are still some larger transactions. I mean, it seems like you're building yourself up to potentially have a target on your back.
Yeah, and so for us, we've always taken the view that companies that are built to be sustainable, that are built on fundamentals, that are built to be around forever in perpetuity, are the ones that get acquired. And so what we're trying to do is focus on what we can control ultimately right now, which is execution, which is consolidation, executing on our business plan. And I believe that if we do a good job of that, we will be a very attractive acquisition target for somebody going forward.
My 2 cents worth as well is like I think there's a very, let's say, a lack of acquisitions in the small space. I think you're doing a wonderful job in being able to roll out some of the smaller assets that are probably too small for the big guys. But the big guys are still active. It seems like you almost have to be of a material size before they do something. And you're clearly getting to the point where you're getting of material size where, again, puts a bullseye square in your back. So I think things get interesting as you get a little bit bigger here.
Yeah, and further to that point, Paul, I mean, we're the opportunity in front of us with what we're doing today and the positioning that we have, thanks to the support of you and our shareholders and of course our team, is making the consolidation side very attractive right now, to where the scope and scale can be very attractive for the LPs. I mean, there's in the Canadian land, in the Canadian space, there's limited people that could pull off an acquisition of us at this point. And I think for them to actually seriously consider an acquisition of us, it would be, I think we would need to also be a little bit bigger. And so, with where we are in that, small and mid space consolidator, I think that we can achieve the size that would be very attractive to those entities.
Yeah, no, agreed. Okay, so Scott apologizes because he says he joined late, but question is, how is the inventory control helping to offset the working capital requirements with your acquisitions? And related, do you believe will be required to, sorry, and what do you believe will be required to raise capital at this point?
Sorry, I don't follow the
Yeah, I'm
beginning.
going to try to do it one more time. Let's talk about the inventory control system. Are you basically working capital? I think working capital is one of the issues that I think that every company faces, but the ability to turn over inventory enough and manage working capital, is it working right now? I guess we'll start with that. And then secondly, I would say, as far as raising capital, I think the function of any capital right now is really to go towards the completion of the acquisitions that you've scheduled here, not so much for the ongoing running the business, which subject to wanting more working capital just to continue to grow faster. Yeah, inventory. Like, are you satisfied that you're turning it over enough to not damage your working capital position right now?
Yeah, and no, that's a great question. And so, obviously we've seen our inventory expand with, acquisitions, and at some point, I think we'll get to a point where maybe acquisitions will slow down, and we won't be concerned with being under inventoried. And, at that point, then maybe we start to deplete inventory down to contribute more to working capital. Right now, we believe it's more beneficial for the company to make sure that we have the inventory we need to capitalize on revenue growth and to push our brands organically, particularly with the product development that we're doing now. And so I think at this stage, we're a little less concerned with the inventory growth, as long as it's not obsolete, which we don't believe we have any inventory obsolescence issues. So we're weighted towards more inventory and more revenue growth opportunity as opposed to depletion of inventory for working capital, as long as we can also continue to access capital and uncover opportunities and transact. And so, maybe in a year or two, we'll start to see the inventory balance start to deplete down once we're comfortable that, we're not going to be consolidating any more assets and we're comfortable that the inventory levels are sufficient to service the revenue that we currently have. But right now we're in growth mode. And we're also bullish on cannabis.
Yeah.
I mean, we believe, right?
Yeah, no, I think this is something to stress. This is sort of counter to what's been happening in the industry, where 3, 4, 5 years ago, when capital was easy to get and the industry was overpaying for a lot of assets, and we can see sort of the result of that. We're now at the trough where assets are going for significantly cheaper and there's a lack of capital. So anybody who can exploit that is able to really take advantage of that shift in the cycle. And I listen, I agree. And I've seen it in so many other businesses. If you have the wherewithal to invest when nobody else is investing, when nobody else is able to access capital, if you can have that going for you, that is a massive advantage that allows you to exploit. And of course, when things get better, you haven't paid, you haven't overpaid for assets. And clearly that's what we're seeing happening with hash right now. And I stress, it's, investing when nobody else is investing is usually your best recipe for success.
I want to, give some props to Bill McDonald here, our co-founder, because he used to do a lot of work for Joe Rotman and in oil and gas, and basically startup oil and gas and junior public oil and gas, building oil and gas companies. And they always said, there's more money to be made in Calgary when there's blood in the streets than any other time, right? And really, that's the situation that the cannabis industry in Canada is in right now. And there certainly aren't a lot of consolidators out there. And this is where you will see the most attractive valuation metrics and the most upside.
Yeah. And I would say, regardless of whether it's cannabis or not, when you're able to pick up assets at 1.5, call it 1.5 times EBITDA, it's somewhat a license to print money as long as those assets, continue to do what they're doing. So, I mean, hats off. I think so far so good.
And to that, Paul, too, and I'm not saying we should have a motif valuation, but I believe the multiples on that deal were upwards of 20 times EBITDA.
That's right.
And so, that's just indicative of kind of what we're doing here in the space that we're in, consolidating assets for much lower multiples. And, we play our cards right. We do hope to achieve a multiple more analogous to that.
Yeah. Yeah. Fair. Absolutely. Okay, so let's go. Next question. Jesus says taxes are a huge toll on your business. I'm assuming he means excise taxes. Do you expect any changes to them with the upcoming government? Do you think a more conservative government would put roadblocks to cannabis companies and products?
That's a good question. Personally, I believe that there will be excise reform. I just don't know when. No one does. Could be this budget, could be 3 years down the road. I think that there's only upside in terms of the excise tax rates. In terms of the conservative government, obviously they're pro-business, so that's good. But they're also, it was liberals that brought that legalized cannabis. And so personally, if I had to speculate, I would think that the conservative government ultimately will help the industry. I don't think that they, could call themselves pro-business without supporting an industry that exists and employs so many people and creates, such substantial revenue for the government. And so, if anything, I look at it as a positive. Certainly, if we were to have a conservative government. But no, that's a very interesting question and one, that is definitely discussed within all the LPs in Canada. And, is this going to be beneficial or is it going to be bad? And I think the consensus is, that a pro-business government is going to help overall.
Well, one other thing I've heard from some players in the industry is that this, the conservative government or the Conservative Party right now is anti crime, and one of the biggest beneficiaries of these high excise taxes is the illegal market. So the idea that the lower excise tax will make the illegal market less competitive, and therefore, would be very beneficial that way as well. So there's a myriad of reasons why the excise tax should be lowered here in Canada. So
No
anyway,
question.
yeah,
I would
that
say, Paul, like the
Yeah.
excise tax rates are, I think, the predominant reason why the illicit market is still surviving and thriving. I mean, it's still roughly 30% of the market. And the price compression that would happen with excise tax reform certainly would make them less competitive.
Yeah, yeah. Okay, Russell says, are you in discussions for further potential acquisitions? If so, can you share what they may add? Like maybe where are you looking if you're still looking right now?
And that's a tough question. I mean, we're constantly evaluating opportunities. You know, we don't want to leave any stone unturned, so to speak. With the business that we have now, I think that it's fair to move up market a little bit, and any acquisitions moving forward for us that would pique our interest would be a little bit larger than what we've transacted going back. And so there's a lot of mid-tier LPs in Canada. You know, there's, call it 3 or 4 very large LPs or 4 or 5 very large LPs, and then there's a lot of mid-tier, a lot of quality companies out there, a lot of strengths, and a lot that basically aren't able to advance their business without transacting. And so we're in discussions with numerous LPs all the time. Nothing definitive whatsoever, no pen to paper. But of course, it is part of our mandate here to conduct opportunistic acquisitions, and I think that as we move forward, the scale of revenue and the scale of businesses that we would be looking at might be a little bit larger.
Gotcha. Okay, so Mark asks a question we've sort of covered, but it says, I've been very focused on what I believe is an emerging shortage in the upper end of the Canadian flower market and increasing B2B prices. Can you add any color and data or anecdotes to this thought or thesis?
And so I agree. I don't know about the elasticity of the market pricing, and in terms of whether assets that have been shut down can be brought back on easily or not. That is a concern. But we have seen prices increase. There's absolutely no question. Obviously, a lot of product in that A grade flower has been going internationally, which depletes the domestic market and puts pressure upwards in price. And so, from our seat, that was obviously one of the primary reasons why we did want to obtain a cultivation asset, and there is balance there now, and so there's a good opportunity, I think, there in the dried flower market.
I agree. We're hearing the same thing from other players. Definitely starting to see price increases. Okay, Paul asks, would you be able to move / use warehouses to reduce CapEx? Is there, I guess maybe the question is there any unused or unutilized capacity that you can further sort of take advantage of?
And so do you mean cultivation wise or
I'm going to guess in
wise?
general. Let's say in general. I know when we did the site visit, we were amazed at how much capacity you guys still had just outside Calgary there. I'm assuming you've probably used up some of that capacity, but how much more utilization is there possible just throughout your whole system right now?
Yeah, and so A and C can be expanded with labor. I mean, I think we could probably at least triple capacity in Edmonton with just more labor, and very, very, very modest, not even CapEx hardly. And then at our massive hash factory facility just near Calgary, we probably have, I would guess, 35% capacity remaining. Of course, we're just going to commission hydrocarbon here in the next month or two. And the activity has really expanded. Obviously, closing the CanMart acquisition, we do a lot of work related to the royalty and Zest brands in-house now, such as their vape filling. Obviously, all the lamplighter vape filling is in-house. All of our ice water extraction and hash making is at that facility. And then we'll probably bring some of the Delta 9 operations into the massive hash factory as well. And so, over time, we're using up some of that capacity, but there's definitely some room left there for growth. And then in Delta 9, I mean, it's a 95,000 square foot facility, where we're going to be taking some capacity out of it into our other facilities, and including the pre-rolling and vape filling. And so, there's definitely unutilized capacity there, both from the retrofit, if we pursue that, $4 million, we could double capacity, but also there'll be some areas where will no longer be used. And so I would say system-wide, we have, quite a lot of excess capacity that we could grow into.
Fantastic. Okay, so Paulo asks, Jeff, do you have any comments on other players in the space right now? We've noticed actually recently a little bit of movement in share price for MTLC. I can't remember the name of the company, but Love, which is
yeah,
exactly, and then Cannabis. Maybe any comments on some of the other players out there in any way, and then I'll give you the second part of the question.
Yeah, and so no, that's a very interesting point, because Montreal Cannabis and Kenara, I would view them as two of the best operators in the space without hesitation. They're quality companies. They're achieving profitability, and they have good scale to their operations, and so I have nothing but good things to say about them. Of course, debt is always a concern, and will always be of concern to investors. But in the context of the Canadian space, I would call them without doubt two of the stronger companies. Cannabis, they're a good company too. They were profitable previously. Had a little bit of a bump on revenue maybe a while ago, but another quality company. And so I think as an industry, there's some good operators are starting to move forward and be recognized and potentially separate themselves from other operators.
Mm-hmm. What I'm noticing is that some of the smaller players, as far as their share price, has been reacting quite positively, whereas a lot of the large ones have not. And if you look at the commonality of the ones that have been moving, it's profitability. Like these companies are generating free cash flow to some degree, and obviously doing the right things fundamentally. And I'm guessing it's attracting the generalists more than the old cannabis investors. So it's an interesting dynamic we're starting to see there. And the other part of the question from Paulo is around institutional interest. Now, we know that, we've made some introductions on your behalf to some of the institutions we know, and we know certainly 6 months ago, they wouldn't even take our phone call. But are you seeing any increased interest from the institutional side? If so, maybe anecdotally, what can you tell us there?
Yeah, I just don't think that there's any doubt that there is more interest from institutions now. I mean, if you go back a year, there wasn't interest from anybody, retail or institutional. And then, of course, with you, Paul, and Trevor, and the small cap community in general, we were able to go through a long period of evaluation and ultimately build the trust to start to be able to do a raise and things like that. And as we've seen it through that period, we've seen a lot more eyes from retail in cannabis. I think that a lot of the fears are starting to deplete about the industry in general, and I believe because there are operators separating themselves that are fundamentals driven and focused on profitability, that that attention is warranted. And then just in the last call it 3 or 4 months, we're absolutely seeing more institutional interest. I think that as a whole, they believe that the operators have started to separate themselves, and that there's a real value proposition in this industry. I mean, the companies we were just talking about, Montreal and Kenara, I mean, they're trading at, a 4.5, 5 times EBITDA, as are we. And so, I believe that, people are becoming believers that maybe the bottom is behind us in this industry, and maybe it's worthy of a serious look.
Yeah. No, I mean, and I know certainly from the discussions we've had very recently, there seems to be a little bit more seriousness and interest from the institutional side. Okay, so I've got a question here about recent quarterly filing. It says, how did the most recent quarterly filing get sent out with messed up figures? And do you know what he's talking about here?
Yeah, we in our guidance, we had to refile it. Just a mistake that was made internally on the wrong numbers getting adjusted, and then we of course caught it before the market opened, and moved to correct that, and then we're halted. And once we were halted, we actually called them to halt ourselves, because we didn't want anyone trading on that. So we got it corrected, and yeah, no egg on our face, and we'll learn from that and move forward.
Fair enough. Perfect. Okay, so Philippe wants revisit this question. Could you give more clarity about why earnings growth could not be similar to revenue growth rate?
Oh God,
we'll beat this. We'll beat this till it's a dead horse here.
Yeah, honestly, I mean, all I can say is, we tried to be modest in our projections. We're a little bit more sensitive to projecting net income growth than we are revenue growth, because we believe that net income is the driver for valuation, and so it could be part of that. And all I can really say is that all of the acquisitions that we do on a post-integration basis have to be profitable, and it has to be profitable on a per share basis, and we won't proceed with it otherwise. And so it's probably a few of those factors playing into that, but we're still, in terms of acquiring an asset for net zero, and building revenue by 12 million, and 1.5 or 20% earnings per share, 15% earnings per share. I mean, we're pretty happy with that. And we just need to make sure that each acquisition is accretive.
Yeah, I mean, I would say there's probably some other dynamics. I mean, when you're buying some of these businesses, there's probably some additional expenses related to these acquisitions that over time go away. But I think the more important metric really is to look at everything on a per share basis, right? So if I'm an investor, I'm less concerned with what the revenue growth rate is per share than I am the net income per share. So if you have to grow revenues by 50% and earnings are only growing by 20%, as long as it's improving and it's being done on a per share basis, I think at the end of the day, it doesn't really matter to me.
Yeah, exactly. And that's what our mentality is there as well. And if you look at this from 9.5 cents to 11, so that's 1.5 cents. But we know the Delta 9 deal is on a post-integration basis, 2.5 million revenue, and we have 100 million shares out. So it should add 2.5 cents.
Yeah.
Right.
Yeah.
So are we intentionally sandbagging our numbers? Absolutely not. We just tend to be conservative when providing pro forma projections, to the public. We don't want to misstep. We don't want to overpromise. We want to make sure that we're being fair and truthful and transparent. And so, that could ultimately get its way into the numbers.
Gotcha. Okay, so Mark says, thanks, but for what it's worth, my understanding is there are no large facilities on the sidelines. They have been shuttered, dismantled. Not sure I'm correct, but this is what I've heard. So I'm assuming they're saying, okay, so some of the assets you've acquired, obviously you're rationalizing them. So you're going to, any sort of excess capacity right now doesn't make sense to sort of keep. Is that, am I viewing it properly? Like some of these assets you're acquiring, you're not going to take it on and have empty capacity. You're going to try to rationalize as much as you can for the time being.
Yeah, absolutely. And
Yeah.
so like I'm not going to say that we're shutting down any further facilities. Obviously, we're always looking at that, but from other parties, there are numerous facilities that have been shut down and that are never opening again. Like the Aurora facility in Leduc is a perfect example. It's a 1.1 million square foot hybrid greenhouse that's now growing flowers, orchids, right? And so that one's not going to come back on stream. And there's numerous examples of large assets being shuttered and that are not coming on. Could we go in there and start it up again? Absolutely, we could. It would just take time and some capital and licensing and people and, you know, building the business again. So, you know, the extent to which there's elasticity in the cultivation space and how quickly supply and demand can be turned on and off, you know, isn't quite understood yet, because this is the first down cycle, right? This has been the first real down cycle in the cannabis industry, as opposed to oil and gas as an example, where, you know, the cyclicality is known to everybody and it's just expected. In cannabis, it's a bit different. Like, I mean, there's large warehouses out there that used to be cultivation that are now, you know, growing or cultivating other things, or they're just warehouses again, right? And so no one can predict how many of those will come back online or stay shut down. But you know, certainly right now with the assets that are operating, it's a much healthier dynamic. I don't think, generally speaking, the LP community is interested in creating another problem like we had before. We understand that, you know, there needs to be a measured approach, and I think the capital markets certainly understand that and wouldn't deploy capital into, you know, frivolous kind of expansion of certain processes and cultivation.
Yeah, I mean, I think case in point, when we're looking at assets right now that are, you know, like yourself, you're trading at basically 5x EBITDA. You know, you're unlikely to see a whole bunch of new capacity come online. Certainly, nobody wants to invest in new capacity when, you know, you're able to go out and get assets or, you know, see valuations that you're seeing right now. It just doesn't make a lot of sense to go and spend money doing that.
And risk, right? Because,
yeah,
you know,
of course,
for us, we wanted to, with Delta 9, one of the primary reasons that we pursued the asset was because we knew what we were getting. We knew of the production history, and, you know, it's not perfect by any means, but we knew what to expect, right? And so having that certainty matters right now.
In my mind, this is, you know, when you look at the buy versus build argument, this is not an environment where you build right now. This is an environment where you buy.
Absolutely.
Who in their right mind would want to go and build a brand new LP or grow up or somewhere in this market with conditions as is? Yeah,
absolutely.
Okay, so question from Brandon here. It says, with the latest acquisition included, but not including any synergies with the acquisition, do you have a next 12-month EPS guidance range? Now, I know you can't really give guidance in this format right now, but I'm going to ask it in a different way. Jeff, based on the acquisitions you have right now, and sort of the perceived, call it capacity, what sort of revenue do you think you could generate from the current capacity? And then the question around margins, what do you think the sort of, call it, gross margins on an average basis throughout the system would likely be?
Yeah, and so we'll give official guidance probably, you know, in the weeks after we close the acquisition, so we understand fully the timing of closing, how long we have revenue, how long we don't, etc. So we will provide guidance at some point. What we have here is just a kind of baseline pro forma 2025 outlook. This isn't official guidance. This is pro forma projections. But, you know, we believe that this asset base is capable of very strong revenue growth in 2025. I believe that we're set, and and we have the infrastructure to get solidly into the top 10 market share, and if not, to ultimately get into the top 7, top 6. We have what's needed, and now it's just a matter of continued execution. Of course, speaking to the unutilized capacity earlier, there's capacity to double revenue from here easily within our current infrastructure or more. Certainly the infrastructure is not going to be what holds us back, and certainly the people are not going to be what holds us back. It's our greatest strength is our people and our organizational capability. And so, when it comes down to getting 2025 kicked off and seeing how these product launches go, which we're going to properly support and make sure that we're doing a good job with marketing, we'll be better prepared to give fulsome guidance. But for now, I mean, I personally would be disappointed if we had small organic growth. The 67 million that we've projected there pro forma, certainly we're going to aim a lot higher than that, and our infrastructure and people support our capability to achieve it. So now we just need to get out there. We need to close the Delta 9 acquisition. We need to make sure it's properly integrated, and then we need to execute. And we need to connect with some consumers and do a good job of driving velocity through the retail stores.
Gotcha. Okay, so the last question I've got so far right now coming in, Joseph asks, what percentage higher is the C-suite compensation, i.e. cash and bonus, as well as share-based compensation, expected to be in mid-2025 compared to end of 2024, under the assumption of including comp cost, if any, pertaining to the acquisition expected to close this month?
I don't expect any material changes to our executive compensation. I would expect that, of course, it will expand, a little bit as we move forward for people being rewarded for performance and execution. Being a shareholder of the company and the largest shareholder of the company, and Bill McDonald being right up there, basically the same number of shares as me, and insiders holding strong positions. We're not about salary. We're about creating value for the shareholders. That's what we do. We're not in the business of being a suitcase employee and trying to take cash out of the company. We're trying to build a company that will benefit our families for generations. And so that's why we've participated in every round, and why we've pushed hard and sacrificed everything we can to support the company, and we'll continue to do that.
And Jeff, looking forward a little bit, do you see, let's say, do you need any additional bench strength? Do you think there's any holes that you need to fill over the coming 6 months or a year, as far as management or any side of the sort of the call it the labor side of things?
No. So with the ANC acquisition, we really did add a lot of bench strength. I mean, we basically had 4 executives before that acquisition, and now we have 8. It's just 3 of them are working solely within ANC for now. So, any executive appointments from this time going forward would likely be related to people that we already have within our team, and we have a very well-rounded group of people that are capable of a lot of different things and have a wide scope of skills. And so we're not looking to hire external people right now, and we want to develop the people that we do have and give opportunity within our team for growth, and that's always been important to us, and now we have even more opportunity to do that with ANC being added and with the talents that they've brought to our company.
Fantastic. We sort of run out of questions, so I wanted to sort of wrap it up nicely. But what's the key takeaway? Like what's the message you want to make sure everybody walks away with today?
I would say overall that there's opportunity in this space. There's there is a way to run cannabis companies profitably, and there's opportunity that's seldom seen within an industry to create value, and I guess for us, we've always focused on fundamentals, and results are what mattered to us, even when we were just absolutely tiny. I mean, we did 7 million revenue in 2023. But that ethos is what matters, and that ethos is why we're here today. We care. Every dollar matters. We really push to save on costs, and the support of our shareholders and the support of the small cap investors, and Paul, you and Trevor, of course, has been huge for us, and we want to just thank you guys for that support, and I believe that really this is just the beginning for us. We're in a much stronger position now than we were at the beginning of 2024. I think the opportunities that we have in front of us compared to the beginning of 2024 are much greater, and what can be built profitably here with stewardship and diligent execution is quite special. And so all I can do is just ask for continued support, and we'll continue to work hard and execute, and I can't wait to connect again in the coming months, and even towards the end of the year, and look back and see what kind of progress we may have made then.
Jeff, I want to congratulate you so far. What we've seen you execute on, it's been outstanding. This looks like another fantastic deal for the company. We are obviously very supportive shareholders and love what you've done so far, and are cheering you on from the sidelines here. So, one more time, thank you for not only taking the time today, but all the effort and the work that you've put in so far to make this happen. We've been speaking with Jeff Swainson, CEO of Simply Solventless Concentrates, symbol HASH on the Venture Exchange, SSLCF on the OTC. Jeff, always great to catch up, and I'm sure we'll catch up with you very soon.
My pleasure, Paul. Thank you so much for having me.
You got it. Bye for now.
Bye.